Hi all, welcome to my channel Satish Vlogs. In this video, I would be explaining the concept of purchase of goods or services on cash on credit. What is this concept all about? What are the general entries which get arises out of this concept? How these purchases should get reflected in the financial statements? All these details I would be explaining in this video. As everybody are aware, the sectors are primarily classified into manufacturing sector and the service sector, right? See, in case of the manufacturing sector, it is inevitable for the manufacturing industry to purchase the inventory because inventories are important to convert them into finished goods, and the converted finished goods which get sold out in the open market. From there, the revenues gets generated and the profits eventually, right? So in that way, the business organization will try to operate its operational activities to manage their business. Okay. Similarly, even for the service industry, like banks normally takes the services from various service agencies in order to manage its operations. So how this purchase of goods or services should be shown in the financial statements and what are the general entries, all those things I would be discussing in this video. With this introduction, let's move to the next slide of my video. In this slide, there is a diagram which depicts like a cycle. This is nothing but an accounting cycle. What is an accounting cycle? What are the various phases of an accounting cycle? All these details I had already shared in my video on accounting cycle, and I would be providing the link for that video in the below box. As mentioned previously, I would be explaining my concepts considering phases of an accounting cycle. So as part of the first phase of an accounting cycle, which is business transaction, my business transaction is purchase of goods or services on cash on credit, right? So the goods or services might be purchased on cash, or if the amount is not paid out immediately, then that amount would be kept as due for a period of time. We normally call it as the services or goods are purchased on credit, right? So hope this is clear. Now let's move to the next phase of an accounting cycle, which is a journalizing phase. What is this phase all about? For whatever the business transaction, we are supposed to create the journal entries, or we are supposed to make the journal entries as part of this phase. Okay, so when the purchases of goods or services are made in terms of cash, then what would be the entry? The purchases should be debited, whether it could be goods or services. If it is a service, it would be classified with the name of the service, or it would be mentioned with the name of the service. Okay, so why we are supposed to debit the purchases? Because these purchases falls under nominal account. What is the rule for the nominal account? Debit all expenses and losses and credit all incomes and gains. Okay, right. So for that reason, we would be debiting the purchases as it is being an expense. Now the organization doesn't get these goods or services at a free of cost. Okay, for that the organization is supposed to pay the money as a consideration, right? So if the organization is purchasing the goods or services on cash, then credit needs to be given to bank. Okay, so bank is a real account, because what is the golden rule for the real account? Debit what comes in, credit what goes out. Here we are paying the consideration in terms of the bank, so we are creating the bank. What if these purchases happens on a credit basis? Then the purchases would be debited as it is a nominal account. Okay, So to which account the credit needs to be given when the purchases are made on credit? It should be sundry creditors or accounts payable, because we are not paying the amount immediately. There is a due date which has been provided by the vendor. By at the earliest by the date, our business entity is supposed to pay that amount. Till that point of time, the amount would be credited to or kept under sundry creditors or accounts payable. And the sundry creditors or accounts payable is a nominal account. So this should be credited. Okay, so the entry is purchases account debtor to sundry creditors or accounts payable account. So now hope this is clear. Let's move to the third phase of an accounting cycle, which is a ledger postings phase. What is this phase all about? For whatever the entries which were created as part of generalizing phase, for those entries the ledger accounts are supposed to be created and the entries are required to be posted accordingly. What were the entries which were recorded as part of generalizing phase? One is the purchases account and the other one is the bank account if the purchases are made on cash, and if the purchases are made on credit, then the account would be sundry creditors or accounts payable account, right? Okay, so these entries would be created, these accounts would be created and the entries would be posted accordingly in this phase. Hope this is clear. Now let's move to the fourth phase of an accounting cycle, which is a trial balance phase. What is this trial balance phase all about? It is a summary of the balances of the ledger accounts. So whatever the postings or accounts which were created as part of ledger posting phase, for those accounts the balances are required to be updated in trial balance. Whatever the balances which are being recorded under the debit side of the balances, trial balance should matches up with the balances which are being updated under credit side of the trial balance. Because as we have been following double entry system of bookkeeping, there shouldn't be any discrepancies between debits and credits. Hope this is clear. Now let's move to the last phase of an accounting cycle, which is a financial statement phase. What are the critical statements as part of financial statements? One is the income statement and the other one is the balance sheet. Okay, so how these how the amounts would get recorded in the financial statement? These would be directly taken from the balances which are being updated in the trial balance. So whatever the accounts which are getting reflected as part of the trial balance, for those accounts the amounts are required to be posted in the financial statements accordingly. As the purchases falls under the nominal account, it should directly hit as an expense in my income statement. And what about the other two accounts, which is a sundry creditors account? The sundry creditors account being personal account which are not paid immediately and which would be due for a particular period of time till it gets paid. So till that point of time the business entity is supposed to pay and it would be kept as an open item till it is completely paid off, right? So for that reason the sundry creditors would be shown under current liabilities of the balance sheet. And what about this bank? This would be shown under the asset side of the balance sheet with a negative signage, right? If the balance is already available, then this amount will directly adjusted with the opening balance of the cash account. The balance sheet should get matches up, because as we have been following double entry system of bookkeeping, there shouldn't be any discrepancy. Okay, hope this is clear. With this, I hope the viewers are able to understand what is the purchase of goods or purchase of goods or services on cash or credit all about, and what are the journal entries which get arises out of this concept, how these purchases should get reflected in financial statements, all these details. Okay, if the viewers like this video, request you to like it share it to your friends and subscribe my channel for more videos. Thanks for watching. Catch you in the next video.